So I'm going to be talking about qualifying with debt-to-income ratios. The mortgage business is kind of crazy right now, as you know. The interest rates are up. The market's crazy. Prices are going up. But it is the year for the first-time home buyer. So that's another class. We'll talk about that another time. But what I'm going to talk about is qualifying with debt-to-income ratios as we move along. I don't have the clicker. How do I use this?
Just click on it.
I guess I should have learned this before we started, right? Oh, okay. All right. So what is debt to income? Your debt to income ratio, or your DTI, which mortgage lenders love to use these little acronyms, is all of your monthly debt payments divided by your gross monthly income. So I get people come to me and saying, well, I'm paying $2,000 a month for rent, and you're saying I only qualify for a house payment of $1,500? Yeah, that's what I'm saying. What happens is that we sell to Fannie Mae, Freddie Mac, the investors, FHA, VA, USDA, and they, excuse me, and they have certain guidelines. Most commonly, they want to use your front-end ratio, which is 32%, which is how much your house payment is versus how much income you have coming in. And then your back-end ratio, they like to see it around 41, and that is what monthly debt shows up on your credit report that you have, plus your house payment, your full house payment, divided by your monthly income. And that's how they come up with the debt-to-income ratios. Those are the guidelines that Fannie Mae and Freddie Mac have put out there for us. Now, those are guidelines, like they say. There's always ways around those guidelines. Certain programs will allow you to go to 50. If you have really good credit scores, you've got good stability, we could probably even get a debt-to-income ratio to go as high as 55%. Okay? Don't like to do that because we don't want to leave you house poor, but there are certain circumstances where people don't have a lot of debt. All they really have is their house payment. They've got good credit, they pay their bills on time, they have good money management, and then we can take a look at the full picture and go higher on debt-to-income ratios. Okay. So one of the things they look at is, is payment shock. So if we have a first-time home buyer, somebody out there who's paying rent at $800 a month, or even $1,000 a month, and now they're looking to buy a house, and you're talking about, right now in today's market, a $350,000 house, which is kind of hard to find in Colorado Springs, you're looking at a house payment of about $2,500, $2,600. So to go from a rent payment of paying $800 to a house payment of paying $2,500, would be considered payment shock. So that would be something that would be taken into consideration on your debt-to-income ratios. Another thing is credit. They look at your FICO score. Do you have good credit? Do you have enough revolving credit? Do you pay your bills on time? The higher your score is, of course, the better your rate is going to be, and also the higher you could go on your debt-to-income ratios if you need to qualify for a higher loan amount. Okay. Loan to value is a risk to the investors, so depending on what your assets are, how much you're putting down could be a factor in your debt to income, or the whole picture of the loan. And then they want to take a look at your residual value. So after your debt and your house payment, what do you have left over for everything else? Because we have to take into consideration what you have showing up on your credit report. Okay? But everybody has, if they have children, they've got childcare. They may have medical expenses. They've got utilities. Those are the kind of things that we don't count. Car insurance. So those things you still have to keep in track and do your monthly budget. Take a look at where you have all the other debt coming out of your pocket, how much revolving debt you have, monthly debts that you have, and then how much you have left over for food, your groceries, your gas for your car, emergency fund for maintenance in case something breaks down. And then stability. Are you moving around in jobs a lot? Or have you been in your job for 5 years and you're stable? You're in the market, the job market. So those are the kind of things that we look out for debt to income. What do we use for qualifying income? So if you're W-2 employee, we will look at what your W-2 income is, how much you made for that year. If you're not on salary and you're on hourly, then your hourly rate. Sometimes you can work 40 hours, sometimes you work 32 hours. We're going to take a look at the W-2 income for the last 2 years and we're going to average that. Sometimes we have construction people that come in and they are really busy in the summertime and really slow in the wintertime, so we're going to average that. That's the income that we can use to qualify you. 1099 income, if you have some extra income, you have a little job on the side, but you're not really filing for self-employed as a Schedule C, you're just considering it other income, then we can use that if we've got a 2-year history of that. Self-employed is sole proprietor, S-Corp, corporation partnerships. We use the net income on self-employed. Now there are some B-paper programs where you can actually get into still a loan if you're self-employed and you write everything off, but you're going to have a big down payment. You're going to have great credit scores. Your interest rate's going to be higher. So there's a lot of other stipulations. So this coming Friday on February 3rd, if you want to hear about that, I'm going to be speaking on that at our club coffee at 9 o'clock on Friday. So you're welcome to come and listen to that. We look at child support and alimony. If you're receiving that, if you can show that you've been receiving that consistently for 12 months, we can consider that. Social Security and retirement is qualifying income. Disability from the VA or SSI, we can use that as well. Rentals, investments, dividends, and stocks and annuities. If you have a history of showing those on your tax returns, we can average those over the last 2 years and use that as qualifying income as well. If you're retired and you have an annuity that's coming in on a monthly basis, or you have a huge 401k that you're accessing money from, we can go ahead and use that as qualifying income too. Second jobs we can use as long as you've been working 2 separate jobs for 2 years. So if you are doing DoorDash in the afternoons or the evenings and you're working all day, we can, on a primary job, we can use all that income, and then on your secondary job, as long as you are claiming it on your tax returns, we can use that income and average it over the last 2 years and use that as well. Okay. And then overtime or bonus. So we can use overtime and bonus. We do have to see a 2-year history on that as well. We average it out, we break it out, we'll do a verification of income, break all of that information out. Bonuses, overtime, sometimes there's differential pay, all of that can be added as qualifying income. So as we need income to be able to keep your debt to income ratios in line, those are the different things that we can use. And there are other things that come up, but those are just the main things that I wanted to talk about today. So liabilities that we have to count in order to keep your debt to income ratios in line. Whatever's going to show up on your credit report, your Visas, your MasterCards, your Kohl's card, JCPenney cards. If you have any computer payments or furniture payments, those kind of things will show up on your credit report. We have to count whatever the minimum monthly debt is that shows up on the credit report is what we have to use. So some people will say, oh, I have a MasterCard. It shows minimum $25, but I always pay $100 a month on it. Then I still only have to use the minimum required monthly payment that shows up on the credit report. If nothing shows up on the credit report, then I have to use 5% of the balance. So if 5% of the balance is more, and it's put in your ratios a little bit high, then we probably want to get a statement to show what that actual minimum required payment is. Alimony and child support, on the other, could be a liability if you have to pay alimony or pay child support. That's something that has to be taken into consideration as a debt or liability. Even though that may not show up on your credit report, it'll show up in your bank statements. So we always know pretty much everything about you because we check everything financially of what you have. Okay. Negative income reported on tax returns from self-employed. So self-employed people will run into this where they want to write off as much as they possibly can so they don't have to pay taxes. Okay. Which is, I don't blame you. I want to do that too. But when it comes down to qualifying for a mortgage, it can bite you. Because now we can only use net income. So anything that's going to show up negative, even though you've got W-2 income, but you file self-employed and now you show negative income because you didn't want to pay taxes, we have to subtract that negative income from your positive income and use that to qualify you for a mortgage. So it can really hurt you. So just have to be really careful on that. Court-ordered payments, like bankruptcy, Chapter 13. So if you filed a bankruptcy, Chapter 13, you still can get a mortgage. It's going to be a couple of years after after the filing of your bankruptcy, Chapter 13. You do have to get permission from the judge that they will allow you to purchase a home. And then there's a payment that Chapter 13 that you're paying back we have to include. So any court-ordered type of payments, if you were being sued and it shows up on your bank statements that you're making payments, those things we have to include. Student loans is a big one. Student loans, people think that because they're in deferment or they're in forbearance that we don't have to count any liability payments for student loans. But we do. No matter if you're paying on them or not, there's just an exception with VA. VA says that if your student loans are deferred for 12 months, and you can show that they're deferred for 12 months, then we do not have to count a payment on VA loans. But any other Fannie Mae, Freddie Mac conventional, FHA, we have to count 0.5% of the balance of what that student loan is as a minimum monthly payment in order to qualify you for a loan. So keep that in mind on student loans. We always have to count that. That's a lot of things, that's one of the most liabilities that people forget to tell me about is their student loans. When I'm talking to them on the phone and they're telling me about their debt, that's one of the things they miss because they don't realize that they have to tell you about that because they're not paying on it, so that it doesn't come to mind until I run a credit report and it shows up. Okay. Rentals on Schedule E. If you have rentals and you're filing tax returns on your Schedule E and you come up with a negative income from your rentals, that can hurt you on your income as well because now you have negative income on your rental properties. So we try to add back things. Business debt. So if you're a sole proprietor and you're filing and you have business debt, let's say you use a Visa or a credit card for all of your business, we will have to use that unless you can show that your business account is paying that debt every month for 12 months consistently for 12 months. Then we don't have to use that business debt. We can eliminate that from the debt to income ratios. So it's really important if you're self-employed to keep your account separate, business account and a personal account, to make sure that if you have to offset any debt that you're using for your business, won't have to be used when you're qualifying for a mortgage. Okay? And then any notes, if you have any promissory notes that you have to pay, personal promissory notes, anything like that, that's going to show up or maybe be of record, we have to count that. So those are the liabilities that we look at that are either going to be showing on your credit report or off your credit report. So I always tell people to get pre-approved. There's a difference between pre-qualification and pre-approval. Pre-qualification is like what I did this morning before I came into the office. I had a phone call, they wanted to be pre-qualified for a loan. I took their name, their information, their income, their liabilities, what they have. They don't really know exactly what their minimum required payments are. They don't know exactly what their credit score is, but they give me an idea. I can take a look at that information and I can go ahead and put some numbers together and say, okay, you qualify for this amount of money. This is what you can go out and shop for. But if they find something and they go out and make an offer, they haven't really been pre-approved. They haven't been run through a decision engine, which is national, which is called the DU decision engine, which lets us know whether or not we can get an approval. I have not looked at any documentation, so I don't know if they've missed telling me about a student loan, or they've missed telling me about something that they forgot about. So it's really not a good idea to go out and shop when you're looking for a house with just a pre-qualification, because there's so many things that can come up. And a lot of times when an offer is made, if they have a letter, they're gonna ask the lender for a pre-approval letter. But if I have not looked at any documentation or ran their credit, then I can only give them a pre-qualification letter, and they could have a hard time taking that offer if they don't see that they've gone through an underwriter or they've gone through a decision engine and having a pre-approval. So pre-approval makes them stronger buyers because they know that an underwriter has already taken a look at their documentation, and yes, they're going to be able to give them an approval based on what is seen at the time of the application and documentation. Okay. So pre-approvals are always best. I did provide information and just the importance of a pre-approval in case you know somebody, you can give that information to them. Know your credit score. So many different programs will depend on what your credit score is and whether or not you can qualify for that. So as we say this is the year for the first-time home buyer. There are special programs out there now, and the government really is trying to work with the first-time home buyer this year. So they have done away with some of what we call the LLPA pricing on the rates. So if they're first-time home buyers and they have lower income, they can get a better rate. So let's say the rate on a regular loan is going to be 6 1/8. We can actually drop that interest rate down to like 5% just from them being a first-time home buyer and using certain home buyer programs. So we have several different types of programs out there. The Colorado Housing Finance Authority has a down payment assistance program where they will give 4% of the loan amount towards closing costs and towards down payment to help with that. And then there's other nonprofits in Colorado that also help with down payment and closing costs. So the government's really trying to do whatever they can, and lending companies are also piggybacking on that and doing their own as well. So first-time home buyers, good information out there. There's also a very good information first-time home buyer class, which people that are trying to get into any of these programs, probably 95% of the time they're going to have to take this class and get a certificate. That qualifies them to use the money for these particular nonprofits because they want them to be educated. They don't want them to go into foreclosure, be in foreclosure after a year or so. Okay. Interview realtors. Always interview realtors as well as lenders, just to make sure that it's a good fit. And speak to your financial advisor. Make sure that you have your budget put together, you know what your out-of-pocket expenses are, you know what you're going to contribute towards your retirement. So Jenny can help you with that, if anybody needs that. And just explore all your options. There's so many options out there right now, different types of loan programs you can do. And there's always a loan for everybody. So no matter what your situation is, talk with a lender, get together with your financial advisor, find out where you're at financially, how you file your taxes, what it's going to take to qualify, and then we can find a program that's going to fit you. Okay? questions? Yes?
If a person already owns a home, but they didn't buy it, in other words, if my mother gave me the home that I live in,
Uh-huh.
if I go and I buy a home, am I a first-time home buyer?
No, not if
Because
you're
I-
on title. Yeah, not if
Okay.
you're on title.
That's what I figured.
Yeah, but many of the first-time homebuyer programs, even though they call them first-time homebuyer programs, you can still own another home as long as you move into that one. So if you bought another home to make it your primary residence and you kept the home that you're in and you rented it out, you can still qualify. There's income guidelines, of course, but the income guidelines are very liberal. I mean, you can make up to $120,000 a year and still qualify for the programs. So, and the family size is different. And then there are certain target areas that if you live in a certain target area or you're looking for a home in a certain target area in anywhere in the state of Colorado, the Colorado Housing and Finance Authority can help you.
But you said, if I keep the home I have and I buy a new one, what if I want to sell the home I have and buy a new one?
You can do that.
Okay.
You can buy another home as your primary residence and live in that one. You can either rent the other one out, sell it, use it how you need to, and you can own one home. You can still own one home and buy another home and still qualify for some programs. They just call them first-time home buyers
Okay.
programs a lot. Yes.
Years ago, I don't know if it's true anymore, but years ago, you had to own the other house 3 years before you could become a first-time home buyer. Is that still true?
It's you cannot have owned a home in the last 3 years, and then you're a
yeah.
first-time home buyer again. Yeah.
Okay, but you're saying you could still keep your house and get a first-time home buyer?
You
That's
can.
what I was
Mhm.
thinking.
On some of the programs, they take the first-time home buyer out of there, and so, but they still have first-time home buyer programs. So, like if you're a true first-time home buyer, haven't owned a home in the last 3 years, and your income is a little bit lower, like 80% of median income, then they have programs specifically for that. But you do have to have, and then you get a lower interest rate, but you do have to be a true first-time home buyer, not owning a home in the last 3 years.
What is the general low income? What is it, 50%? You said something about 80%. What, I mean, are we at 4,000 a month or
So
5,000?
typically, there's a chart, and I don't have it with me, but you can have like a family of 4 making up to about $64,000 and be considered 80% of the median income. And then every county has their own income limits. So there's a chart that shows all of what the income limits is, income limits are. So if you're interested in that, I can get that link over to you. And it tells you what those income limits are. Now, people that are at 80% of median income right now, depending on where you're looking to purchase a home, may have a hard time finding a home. But the market right now is a buyer's market. We're back into a buyer's market. And so because the rates are high and the houses are high, the sellers are now helping. We're seeing a lot more contracts coming in where the sellers are helping to buy points, to buy the interest rate down. That helps them qualify for more of a mortgage. They're paying for closing costs because their homes are staying on the market longer. The average right now is 40 days on the market, where not too long ago we were looking at 25 offers, within 4 hours on just one home. So the market has really shifted. So we just kind of go with the flow. See where the market is. The interest rates have come down a little bit. A few weeks ago they were in the 7s, and now we're back into the 6s. And if you want to pay a point, you may even be able to get into the 5s.
The prices of the houses is what I was talking about.
Yeah, prices of the houses, we're starting to see the prices of the houses come down a little bit lower. I think we're starting to see a lot more concession first. So instead of bringing the price of the house down 10,000, they're offering 10,000 to pay in closing costs.
Wow.
So, and points to buy the rate down, so it makes it more affordable for people to get into the homes. So yeah, it's a different market right now. Yes.
What I say in Colorado is there's still a shortage of houses, so there's still a lot of people moving to Colorado, keeping that price high. I bought my house almost at the peak of the market, not quite, but almost. And what I've learned is, yes, there are some places across the nation that are coming down in overall price, but Colorado's kind of difficult right now in that sense. But she's right, there's not people fighting where you're like paying $60,000 over the offer price, but I've heard most people are still getting kind of their offer price, is what I've heard, right? So, and that's just because people keep moving here, you know, or people are cash buying from California, or whatever, you know, because they can't. So, that's the problem in Colorado.
Yeah.
I'm from the Kansas City area, so I know it's more expensive here than there. But, houses have come down a little bit in Kansas City, but not in Colorado so much, so.
Great, so if you have any other questions, I'll be around. You can just pull me aside and ask me, but